Good afternoon and welcome to this week's macroeconomics analysis session for October the 9th, 2015. Welcome everybody. David here alongside with Jeff. How are you, Jeff?
Yeah, good, thanks, David.
Very good. Let's get underway. First of all, our disclaimer. As always, the content of this presentation or any other Elite Wealth Club material does not constitute a recommendation, nor does it take into account your investment objectives, your financial situation, nor your particular needs. So, before making an investing decision based on the general advice presented in any of our presentations, please consider whether the advice is appropriate in light of your financial circumstances. All right, let's get underway. The week in review. Jeff, a bit of data coming out of Australia this week. Some important information, some data coming out of the US. A bit of a recap on Japan and Canada as well. The big news out of Australia this week, Jeff?
Yeah, look, the RBA was certainly it was the big one, and in some ways, and a quiet one in others. So, RBA left rates on hold at 2%, and gave no indication about anything, really. The statement was very similar to the previous months.
Yep.
So, basically, no news on the RBA. What is interesting, though, is that a lot of people had expected that the RBA might cut rates next month. Excuse me. And if that was the case, the RBA might have given off a bit of a signal
clue.
This month, just suggesting that might be in the offing for next month. So I think that's probably off the table now. Not only rates on hold now, probably next month, and unlikely to cut in December. They don't have a meeting in Jan. So, look, rates probably staying on hold till early next year. Maybe Feb.
Yep.
Otherwise, in Australia, the job ads data, which is, look, a lot of people don't pay a lot of attention to this one. I quite like it. The job market in Australia has been pretty solid in the last 12 months, much stronger than expected. And last month's data was pretty good. The unemployment numbers, that is, jobs numbers.
Yep.
Job ads this month, or this week, were the strongest they've been in over a year. So that actually is a good sign for the next couple of months.
Yep.
And we've got jobs data next week, actually, the official jobs numbers, and that suggests that the jobs numbers should be pretty solid. Yep. So jobs continue. I think there've been more jobs created compared to expectations for the last 5 months in a row or something. So we could see that happen again.
Yep. Okay.
Over in the US, the big news probably was the FOMC meeting minutes released in the wee hours this morning. And that was some really interesting commentary in there, actually. First of all, so this is the meetings from their the notes from their latest meeting. At the latest meeting, they kept rates on hold. In the September meeting, there were thoughts that the Fed might raise. Really, they're looking to do two things before they raise rates. The US economy, mostly the jobs market, is strong, and making sure inflation's under control. If inflation looks like starting to pick up, then they'll need to raise rates. So, jobs market has been really good. We've since seen some actually bad jobs data.
Yep.
Last week.
Yep, that's right.
And so that means that the one pillar that was pushing them to raise rates is probably a little bit off the table. And so what was really interesting from the minutes is that the members basically said, look, inflation really doesn't look like being a threat for a while. So there's the jobs is okay, but there's really no rush on inflation. It almost seems like they're giving themselves an out. We said when the jobs market was really strong, we'd raise rates. The jobs market is really strong, but now inflation is so soft we shouldn't really do anything. So I think they're just making more excuses to just push it further and further out.
And that seems like they've been doing that for the last 6 months, doesn't it?
It's actually really for the last few years, even before Yellen, when Bernanke was at the helm, and whenever he would make a comment to say, look, we need to get back to normalising rates, and the market would panic, the next time he made a speech, he would quickly backtrack and say, oh, look, we're shifting the targets, the goalposts, and the Fed's done that continuously with the jobs market. Once we get to jobs, unemployment under 6.5, we'll raise rates. We're at 6.5, but there's a bit of softness. We're at 6, but we're not ready yet, and just another one of those.
It's the boy cried wolf sort of syndrome, isn't it?
I completely agree, and perhaps the Fed is actually using the threat of raising rates more than the raising of rates itself. So I think they know they need to raise rates. They're very reluctant to do so. So what they can do is just tell everybody that they're going to, get everyone to act how they sort of should, but not actually have to pull the trigger. So that was the big one, and that actually, that probably, and the jobs data and the bad jobs data in the US last week probably set the scene this week. The US dollar was down, commodity prices were up because, lower US dollar is good for that, and overseas markets just went ballistic. So that sort of bad news in the US is good news for global markets.
It's interesting because at the analysis session on Monday, I basically said, look, because the jobs data last Friday was pretty poor, really, and so it was the whole theme was bad news is now good news again. We've got bad news on the jobs front. There's no way that the Fed's going to do anything about interest rates in the short term with that as a backdrop. And the market rallied, very, very strongly on Friday, and it's continued to do so all this week. And probably will for the next couple of weeks, without any fear of, if they don't have to worry about interest rates going up anytime soon, then there's a good chance that this market can get back, particularly in the US, to its highs prior to sort of September. So, which is good for obviously US stocks. It's good for the Aussie watch list as well.
And in particular as well, US dollar weakness is going to help commodity prices. And, interesting, I told my members yesterday that resources outperformed the general market in Australia, resource stocks, outperformed the rest by about 5% this week, which is huge. The biggest week the mining sector's had in years. But it was actually, the resource sector was down 25% more than the rest of the market for the calendar year, or last 12 months I think it was. So it really needed that bounce. So that's going to be great for our market, that sort of downward bias that we're seeing in that bad news.
That's been one of the lagging things, isn't it? That because that's a big sector of our market, and if the financials aren't moving,
not quite as big as it used to be, but
not quite as big. But if the financials aren't moving, then what's going to drag our market up? Well, it's the next biggest sector, or the mining services and mining industry. And so if those stocks are starting to get a little bit of benefit from that, then obviously that's going to help sort of float the boat a little bit as well.
Correct. Yeah.
Anything Japan, Canada there, Jeff? Anything unusual happening there?
Just briefly, in Japan, they didn't add anything to their existing stimulus program. There is a major a policy announcement in 3 weeks. So today's statement is this week's statement is a bit of a precursor, and then they have an official meeting at the end of the month. There's quite a lot of thinking that we could see some more stimulus there. And I've been saying, for a while, I think we'll see some more stimulus from Japan by the end of the year. And in Canada, similar to Australia, in fact, both Australia and Canada, obviously, much wider trade deficits, really on the back. Both of them were on the back of poor resource exports.
Well, let's perhaps go and have a look at what happened on the markets this particular week and the indices. The XJO there, as you can see, we're still at this point in time we're still in extreme risk territory at the moment. You've got to remember that the stochastic that we're using for our market risk indicator is a lagging indicator. Everything lags other than price action itself, and you'll see the price action recently, particularly the last half dozen periods or so, has been very strong to the upward side. And that will eventually drag our indicator up out of extreme risk into very high risk in the next few days. And if we have a strong close to today's market, I'd expect that by Monday morning this indicator would be into the very high market risk area. At this point in time, it's still got a fair way to go to get back up to 5,300, but certainly if the strength continues, I can see that getting back up there pretty easily. the real significant point from our market's point of view is really if we can get a close back up above the 5,300 level, sort of somewhere up around the 5,400 level, I think would be good for our market. And if the miners keep continuing to do some of the heavy lifting, etc., then we'll probably get there at some stage. The US, the same token, has rebounded very, very strongly. Again, from around about 6 or 7 sessions ago, has just continued to go upwards very, very strongly. So you might remember a few weeks ago I talked about a dominant candle, and it's still this one way back up here at sort of the 475 level. We've already challenged this one. We failed at that area the first attempt, but since then we've come back up. We're closing at these levels again. So if we have another couple of strong sessions on the US market, we're going to be back up into this trading range that we fell out of towards the end of August. So if we can do that, and there's no fear about the interest rates having an impact on the markets, etc., then the fear seems to have disappeared for a while, and markets could well rally for a while yet, and we may still get a Santa Claus rally. So let's keep our fingers crossed for that at the time being. Next week, let's just have a bit of a look and see what we've got on the calendar for next week. The week ahead, Jeff, a fair bit of news coming out of Australia there and the US as well. What's the important data as far as the local exchange is concerned?
Yeah, in terms of Australia, I mean, now business confidence and consumer sentiment are always interesting to keep an eye on. They've been pretty ordinary recently. Both of these are the first readings since the new Prime Minister is in charge.
Yep.
So we'll see if we get a bit of a Turnbull bounce, I guess. So that'll be interesting to keep an eye on. Unemployment data as well. I mentioned the job ads,
Yep.
which is a bit of a predictor, a leading indicator. So I think that the job numbers coming out next week should be pretty solid. The market's expecting 5,000 jobs to be added.
Yep.
For the month. If I had to pick, I'd say probably stronger than that again.
So if we do get good job numbers, the Fed sitting on their hands for the time being, the Aussie dollar likely to get a boost
Yep.
on the back of that.
Yeah, I think if we saw really strong job numbers, you could see the Aussie dollar jump 1% in
Yep.
sort of 24 hours, sort of
Yep.
thing like that.
Yep.
RBA Financial Stability Review, probably I think they'll spend a lot of time talking about the the housing sector.
Yep.
In the UK, interestingly, they've got rates at 0.5%. They basically have no inflation at the moment. They want their next move will be higher, and their rates will be higher. They basically have zero inflation, and they recently came out with minutes as well, and everyone there basically on the board basically said, look, there's no threat from inflation. We don't need to act, and they're probably not going to raise rates till second half of next year.
Yep.
China as well. The inflation official CPI figures are fairly low. I think that'll come in, but probably below 2%. And in the US, also CPI as well. Core CPIs. I think it'll come in at something like 1.8% or something for the year. It's not at it doesn't look like getting to the Fed's 2% sort of level where they need to act.
Yep.
Core retail sales are expected to struggle as well. So, a lot of inflation data out next week. So obviously implications for global rates.
Yep.
But I don't think any of those are going to tip the balance over to rate hikes anytime soon.
Yep. Interesting photo that I've attached there this week, Jeff. Christine Lagarde.
Mm-hmm.
She's the lady who's in charge of the IMF.
Yes.
Came out with a statement saying that there was certainly no hurry to raise rates from the US point of view, and that actually the global economy, etc., was really, really struggling. Quite a dour assessment of economics around the world. What's your take on that? Is that something that was just to try and reassure everybody that the Fed was doing the right thing by keeping rates on hold, or?
No, I think it's a lot of those comments are made for with an audience and a purpose in mind, rather than hardcore economic policy in mind.
Yep.
I think this one is probably the case of having a bit more backing behind it. Certainly, I think the IMF's taking a global view that US can its own economy can probably withstand slow and gradual rate increases, but it will have major implications for global markets. And I read something this week. The IMF thinks that emerging markets have probably borrowed about $4 trillion. Governments and companies have borrowed $4 trillion too much in this world of low rates. They are hugely leveraged, and once when the US does start raising rates, a lot of money gets sucked out from developing countries, emerging markets, and actually funnels back into the US.
Yep.
So I think she's actually basically saying, look, the world is on a bit of a precipice, and the US rates is not just about the US economy, it has the potential to...
Has broader implications.
Oh, yeah, I mean, obviously it does, definitely. But in this case, it's just, you don't want to pull the rug out from under really the entire... global markets, not just the US. So I think that's probably what she has in mind. So she doesn't, I don't think she's fussed about US unemployment and US inflation and those kind of considerations. She's saying, well, this could really have, cause huge ripple effects. And as she said, and you sort of said as well, that the globe is not in a strong enough, or potentially not in a strong enough position to withstand that right now.
Yeah, no, interesting feedback there, Jeff. Thanks very much for that. Well, that pretty much concludes the macroeconomics analysis session this particular week. Hope you all have a good weekend. For those of you in the ETC, the Elite Traders Club, I will catch up with you at 9 a.m. on Monday morning. So until then, have a good weekend. It's bye from me.
And it's bye from me. Thank you, everyone.